It's back. I've been waiting for this program to come back. And what is it? It's a conventional loan that has a down payment assistance program associated with it. And what does it look like? Well, it's not a 5% down conventional loan. It's not a 3% down. It's not a 2% down. It's only a 1% down conventional loan program. So it's incredible. And so in this short video, we're going to talk about the benefits of the program. We're going to go over the guidelines and some of the restrictions. We're going to show you an example, as always, so you can kind of see how the numbers work. And so if all this is of interest to you, watch it all the way through, share with your family and friends, and let's kick off this rodeo right now. I'm Kevin Fagan. I'm the Mortgage Patriot on your side, nestled here in the hill country above San Antonio, Texas, serving all you proud Texans and all you great folks all around the country. So again, another great one as always, because why? Because we're going to talk about, as I mentioned earlier, a 1% conventional loan product that's going to really provide some great assistance for you. So as I get into that content, if you would, look down below, hit the like and subscribe. It really helps me with the YouTube algorithms and brings my content up to the forefront and helps educate you. And you can see some of the examples of my videos right here where I talk about the advantages of certain FHA products, certain VA loan products for veterans, renovation type of loans. I cover a lot of subjects here, but here again, we're going to talk about the conventional loan and what this special down payment assistance program, how it benefits you. So let's get into that content right away. So let's talk about those benefits right now. And what are they? Well, there's three main benefits. The first one is very simple. The first one's very obvious. It's a 1% down. So you're saving quite a bit at the closing table, meaning the check that you write at closing for everything is going to be dramatically less. If you have an FHA loan, for example, which most people choose because of its low down payment requirement, it's only 3.5%. So let's take an example. A $300,000 home, 3.5% down just for the down payment portion on an FHA loan, that's $10,500. That's how much you have to come out of pocket just for the down payment, not including closing costs and not including escrows. With this product, it's only a 1% down. $300,000 at 1%, that's $3,000. So that difference between the FHA loan and the 1% down conventional loan is $7,500. The difference between 10.5 and 3. That's a major difference. So that's saving you quite a bit of money at the closing table. Now, benefit number two is enormous. The conventional loan allows you to circumvent any issues, safety issues particularly, that are existing in the house when you try to buy it. What am I talking about? Well, if you have an FHA loan, or you're starting with an FHA loan and you get an appraisal done, they send out a certified FHA appraiser. And they're going to mark certain things on the home. If it's, let's say it's an older home and it's got some safety issues, like it's got maybe some bad wiring, the wiring box is a little old or faulty. Maybe the roof has got leaks in it. Maybe the foundation has a crack that looks maybe unstable. They're going to mark these things and they're going to compel the seller to fix these before closing. I'll say that again. They're going to compel. That means that you have to do it. The selling party or you to fix this before the lender gives you money. Well, a lot of times that just can't happen, right? The seller's saying, hey, I'm not going to pay for this. I can't afford to be paying for this. And you're saying, well, I'm not going to pay for it. Why should I pay for it? The conventional loan circumvents all that. When a conventional loan appraiser goes out and they just mark, they notate these items, these safety items, but they don't compel the seller party to fix it. So you can just march along with your loan as if it's not a problem. You can fix those at your own timeline with your own resources, but it doesn't stop the loan. So a lot of times selling parties don't even allow an FHA loan to even be started because they know that this issue is going to arise. So again, this conventional loan circumvents all that and you just march on down the road and avoid all these problems at the onset. The final benefit, which is equally big, is potentially the difference between actually getting the home you want and not getting the home you want. Now, this only applies to married couples, but let me give you the example and what's going on here. On the conventional loan, the non-income earning spouse does not have to have their debts included in the income earning spouse's debts. What do I mean by that? Let me give you an example. Let's generalize and say the husband is working and let's say he's making between $70,000 and $80,000. The wife is taking care of some children, okay? But she has a car note and some credit cards. Her car note is $500 and her credit cards, these are all in her name, are $200 a month. So she has $700 of debt. In an FHA loan, even though she's not on the loan, the husband would only be on the loan, her debts have to be included inside of his debts. So that restricts the amount of house that you could buy, potentially restricting the house that you want totally. But in the conventional loan, it totally ignores the non-income earning spouse's debts. So only in this case, the husband's income and debt load would only be considered for the loan purposes. That's a major difference. I've had this happen maybe 3 or 4 times. We've had to change from an FHA loan to a conventional loan because we couldn't get the house that they wanted because the non-income earning spouse had too much debt that had to be added, again, to the borrower's side. So that's a major benefit of a conventional loan. It doesn't require that. As I talk about the guidelines and restrictions for this program, let me remind you, as I do often, when we're talking about down payment assistance programs, you have them in all flavors. You've got national programs, you have state-run programs, you have county programs, you have city programs, but you also have lender-specific programs. This is a lender-specific program, meaning if you watch the video and you think, hey, this is really for me, you can't go down to your local savings and loan or bank and say, I want the 1% conventional loan product. It's only specific to this one lender that I have access to. So they're basically extending a grant to you for the benefit of taking on home ownership. So it's a great program, but again, it's only specific to this one lender. So let me go through the guidelines and the restrictions of this program because there's really not that many. So the very first and foremost is it's a primary purchase program, meaning if you're trying to identify an investment property, you want to put some renters into it, that's all fine and great. I can help you there, but you can't use this program for that. Your intent has to be as a primary owner, primary residence. And secondly, it can only be a single family residence. In other words, if you come across a duplex that you like and you're going to move into one side and rent out the other, again, you cannot use this program. Thirdly, it can be used as a first-time home buyer, but it doesn't have to be. So in other words, if you're rolling out of another existing home that you own, so it's not your first rodeo in terms of ownership, that's still fine. You can still use this program. So not just for first-time home buyers. That's pretty good. In terms of credit scores, the credit score has to be 620 or better. And that's typical among most down payment assistance programs. And if it's below 620, I can help you with some ninja tricks on how to raise your score. So don't worry about your scores too much. But 620 is a pretty good guideline. Lastly, it's an income restricted program, meaning you can't make too much money. And that's the case with all down payment assistance programs. So what do they base it on? They base it on area median income, AMI. So for every county in the country, whatever county you're in right now, there's going to be a number assigned for the area median income. This program allows for up to 80% of the AMI. So say your AMI, your adjusted median income for your county is $100,000. 80% of that obviously would be $80,000. So in other words, your household income cannot exceed $80,000 to enjoy this program. That's how it works. So if you don't know your area median income, put it in the comment. Just put what county and what state you live in. And I'll be sure to make sure that I respond back to you and tell you what that area median income is for your county. And we'll go from there and see if I can help you out. So let's get into some numbers and show you how this program can benefit you greatly. Okay, let's see where the rubber really meets the road with a live example using numbers. I like to always use a $300,000 home as an example. So let's compare an FHA loan at 3.5% down with the 1% down conventional loan and see what that difference looks like in terms of writing a check at closing. So if y'all are familiar with any of my videos, I always talk about the 3 buckets of closing costs. So bucket number 1 is your down payment bucket. Bucket number 2 is your transaction cost bucket. Bucket number 3 is your escrow bucket. I'll explain those. Bucket number 1, in the terms of FHA, is the amount of down payment. In the case of an FHA on a $300,000 loan, your FHA loan is 3.5% down requirement. So on $300,000, that's $10,500. You have the right that you'll be coming out of pocket on just the down payment portion. Bucket number 1. Bucket number 2 is your transaction cost bucket. What is that? Well, that's your cost of all of the things that go on during the loan effort. Appraisal costs, processing fees, underwriting fees, government recording fees, title fees. List goes on, right? That's bucket number 2. In the state of Texas anyway, that's going to cost about $5,500. Bucket number 3 is your escrow and prepayment bucket. What is that? Well, you have to prepay insurance, property insurance, to the tune of 12 months. And then you have to fund your escrow to the tune of another 2 months. And you have to fund your escrow to about 4 or 5 months of property taxes. All that together, at least in the state of Texas, your state will vary, of course, is about $4,000. Okay, so we have bucket number 1 at 10.5, bucket number 2 at 5.5, bucket number 3 at 4,000. If you add all those numbers up, you should get $20,000. So in other words, if you purchase a $300,000 house, expect to write a check for about $20,000, assuming that nobody's helping you with down payment assistance or seller concessions. Now let's compare that to the 1% conventional loan. Obviously, bucket number 2 and 3 are going to be the same, but bucket number 3, your down payment is going to be dramatically different. Instead of $10,500 in the FHA example, it's only 1%. 1% of $300,000 is $3,000. That's a $7,500 difference. So on that check of $20,000 you were expecting to write, we can subtract $7,500 out of that total, and now you're talking about $12,500, a little more manageable. And if I can get you seller concessions, which I typically can 9 out of 10 times, if you're using me, I know how to structure these deals very well. I should be able to get you at least $6,000 on a $300,000 home. So now we can take another $6,000 out of that 12.5, and you're writing a check now for your final total around $6,500. That's what I'm finding is the typical scenario that you're writing a check for, and you're getting help from a down payment assistance source like in this 1% deal and seller concessions, which I can help you with. So hopefully all that makes sense to you. It's a great program. I hope you can qualify for it. Look down below. Call me at 210-317-6514 or email me. I always answer my emails and my calls. I'm the Mortgage Patriot on your side. Make it a great one.